Now, major indices here in the States in the green still as investors are digesting the latest private payroll data coming in softer than expected. We're seeing continued moves to the upside ahead of the market open. The NASDAQ up just 0.4%, now pushing over 0.7%. The S&P nearing 0.4% of gains as well. All three indices are climbing here after a slew of weak economic data. So to break down what investors should be watching in today's trading day, we've got Michael Arone. He is State Street Global Advisors Chief Investment Strategist here. Michael, great to speak with you. How excited should I be about a potential new all-time high as I'm looking at these markets continuing to move to the upside this morning?
I think you're going to be getting fitted for another record-breaking hat. So I think ultimately what's happening here is you can see that tech continues to drive earnings growth. Just look at what's happened in the last couple of days. Hewlett-Packard Enterprises, CrowdStrike, excellent results, driving technology. Then you go to today, Campbell's Soup, Dollar Tree, somewhat kind of differentiated from that standpoint, struggling a little bit. So tech continues to drive earnings growth. It continues to drive the market higher while the economy cools, inflation cools, and now all of a sudden 10-year yields are falling. This is exactly what the markets were hoping for and what they want to drive markets higher.
So what's the last thing the markets want to see right now?
I think that we're really flirting, Brad, with this notion of it's a kind of a game of chicken. And eventually bad news will become bad news. We're just not there yet. So what they don't want to see is two things. They don't want to see the economy flirt with that recession. They don't want a recession. And the other thing they don't want to see is inflation continue to remain sticky. I think they breathed a sigh of relief, they being investors, when PCE came in kind of more stable and some of the inflation measures began to kind of show signs of decelerating again. So I think the two things they don't want to see is a recession and sticky inflation. So provided we don't get those, I think the markets will continue to move higher.
I want to kind of get your guide to how we should be reading the market moves that we're seeing off of these data prints, because just 2 weeks ago it was, oh no, we're way too hot, huge market move off of that. Now suddenly it's all good. Who exactly is trading on these data prints, and why do the moves appear to be so big but also so volatile and flippant?
So I think the big thing is this kind of ambiguity around monetary policy. So everybody, in terms of market participants, whether it be algo traders or retail investors or professional kind of asset managers, all continue to struggle with the direction of real interest rates. And all you've really needed to know to predict short-term movements in the stock market is how are real interest rates, are they rising or falling? And ultimately, when they're falling, you see greater breadth, more participation, small cap acts a little bit better, cyclicals, value, et cetera. Ultimately, when real rates are expanding or increasing, it tends to be more reliable growth, more of your Mag 7, more of your tech names, and you see a little bit more downside volatility. I think that that's really been the key to market action for a while now, the ebb and flow in real interest rates.
Well, one of the other keys to market action is the AI hype. That's taken hold in the markets, specifically semiconductors. They're up around 21% year to date. Do you think this momentum can continue?
I do think it can continue. You think about this now, semiconductors are kind of the key ingredient to the global economy. They go into so many of the products and services that we now use that they're kind of this key critical ingredient. Growth rates remain incredibly high. Usage remains quite wide. So from my perspective, we wrote back in kind of November of 2022 that we liked semiconductors for a lot of those reasons. They were coming off an incredibly difficult year, their first negative year in a decade, yet 75% of them, Brad, are profitable. So despite the fact that valuations are a bit stretched, these companies make money and they go into everything we use, both from a consumer perspective and a business perspective. So I do think that it can continue. I do think that you will see some broadening, right? And now we're seeing some competition for NVIDIA. That's going to play out, right? So folks are going to try to take market share from NVIDIA. So the relative winners and losers may change over time, but the industry should do pretty well.
Okay, well, on tech, I know that you wrote in your notes you prefer equal-weighted tech. So I've got to show equal-weighted tech versus the NASDAQ here. You know where this is going. How do you justify equal-weighted tech when you've got the top 5 stocks all of them tech names, now accounting for 27% of gains in the S&P 500.
So I think that's the thing, is that's what's happened. We want to understand what could happen going forward. So if you believe that inflation will cool, the economy will still expand, ultimately we won't enter recession, that kind of so-called soft landing, and interest rates and real rates will begin to fall, you should see a broadening of the market. And so ultimately we should see greater participation, not only from the broader market, but also within tech. So I think that from that standpoint, I think that would be helpful. I think Jared, just before this segment, was talking about Apple. Sequential revenue growth in Apple for the last several quarters has been declining. And ultimately, the stock has struggled to move higher. So I think, from my viewpoint, you want a broader kind of exposure to tech companies that are growing more reliably. And I think that moves beyond just the top 5 names. I mean, the Mag 7's become somewhat of the Fab 4. I think ultimately you're going to see some broadening of growth. You see CrowdStrike today, you see Hewlett Packard Enterprises. Mm-hmm. So I think that you'll see better growth in broader tech. Therefore, you want some equal weight.
You mentioned Apple and WWDC. That is going to be the next major event for that company. And it's really going to be a critical kind of nexus or question mark of when consumers can expect some of this game-changing technology and generative AI to make it to their fingertips and what kind of staying power it has. How much of that kind of mindset is also needing to play into the trading thesis around it as well and the broadening?
Absolutely. So I think that we really need to move kind of from AI, the possibilities to AI, to the practical implications of AI. Mm-hmm. And I think Apple is going to be kind of a key figure in how that plays out. So they're looking to adopt AI technology within consumer products as quickly as possible. But there is some element of a lagged effect. In fact, Bill Gates has this quote around the notion that as it comes to new technology, we tend to overestimate what can be accomplished in a year, but underestimate what can be accomplished in 10 years. I think that kind of rightfully explains where we are in AI. And that's why I think the early builders of the infrastructure, the foundation, are the winners. But what I expect, Brad, going forward is that those that through trial and error figure out how to use it more effectively, more profitably, either kind of from a growth perspective or from an operating efficiency perspective, those will be the winners. And I think right now, as you point out at the conference, and ultimately kind of from what Apple's trying to figure out and others in consumer products, once the winners and losers will become more evident as we move forward.
Well, using that Bill Gates quote as a measuring stick, I still have 3 years left on the clock for the number of blockchain mentions we had back in 2017. Michael Arone, who is the State Street Global Advisors Chief Investment Strategist. Michael, great to see you this morning.
Thanks, Brad.